Hello everyone and welcome back to our channel SQE1. And apart from taxation, we will conclude our discussion on business law and practice with our chapter 8, where we explore limited liability partnership, a hybrid between partnership and company. So it's a fascinating concept of British law. So don't let the name fool you. This is not just a partnership that refuses to take responsibility. LLPs are actually a clever hybrid, part partnership, part company, all legally intertwined. So, what exactly is the LLP? Well, under Section 1, Subsection 2 of LLP Act 2000, it's a body corporate with its own legal personality. That means it can own property, enter contracts, sue, or be sued, all without involving the members personally. Think of it as a very independent teenager. It can make its own decisions while the parents, or rather the members, we in this case, enjoy protection from the consequences. So, what are the formation requirements for LLP? An LLP is formed by two or more persons. That's right, a solitary soul cannot start one. No lone wolves here, So these foundation members, called initial subscribers, must sign incorporation documents and comply with LLP Act 2000. And here's the beauty: unlike companies, you don't need a formal agreement to start an LLP. If you don't, so the 2001 regulations swoop in to provide default rule. It's like having a safety net. You can jump in without a net, but one's always there if you need it. So, so name and execution, that's what we need to understand. That name matters for LLP. An LLP's name must end with LLP. You need to write it. Otherwise, the poor accountant at company house might just faint. And if your LLP has more than 20 members, you can avoid listing every single name, provided you maintain a list at the main office. When it comes to signing documents, it's either two members or one with a witness. For deed, like all kind of deeds, more formalities apply, but nothing a keen pen and a witness can handle. And of course, register must be maintained. Members, charges, and debenture holders. Transparency, my friend, in LLP, it is transparency that matters a lot. So, on concept of separate legal personality, the magic of LLP is that it got its own personality. The LLP is its own entity, and your personal assets are generally safe if things go pear-shaped. Your liability is limited to your capital contribution, unless, of course, there is fraud or wrongful trading, then all bets are off. So, and there is a perk, unlimited capacity. The LLP can do anything a human can do: buy property, make contracts, no objects clause nonsense. It's like giving your LLP the key to city. So, the next thing is member and designated members. LLP must have at least two members at all times. And then we have the designated members, a sort of elite squad responsible for compliance with statutory requirements. These brave souls must ensure accounts are filed, confirmation statements are submitted, and registers are maintained. If you fail it, it's criminal liability. So think of designated members as compliance superheroes of the LLP world. So the next thing we need to understand is default provisions and members' duties. And there is no formal LLP agreement. 2001 regulation provide default rules: equal shares of capital and profit, participation in management is optional, no automatic remuneration or for management, majority rules for ordinary matters, unanimous consent for change in business nature. Members must also account for profit from competing business, disclose full information, and ensure books are accessible. It's all about transparency and trust, but with a hint or pinch of law. So, what is authority, fiduciary duties, and unfair prejudice? Members are agents of LLP with actual, implied, or apparent authority. But beware, LLP are not bound by unauthorized acts if a third party knows or should know that the member had no authority. And that applies on partnerships as well. Unlike traditional partnership, members do not owe fiduciary duty to each other by default. Duties only arise when acting as the LLP agent. And if things get messy, members can petition for unfair prejudice, similar to minority shareholders in a company. It's a legal equivalent of calling in a referee for a very intense game of Monopoly. Taxation and winding up. Say, that's very important. LLP are tax transparent. Profit flows through to members who pay income tax, and if they were partners, so once they are like partners, they pay in the same way their income tax on the income. No corporation tax, simple, isn't it? In company you paid. When it comes to winding up, LLP follows procedures similar to companies, CVAs, administration, liquidation, and remember the clawback rule. Any withdrawal in the 2 years before insolvency can be reclaimed if the LLP was going belly up. So don't be tempted to empty the till like it's Black Friday before insolvency. HMRC has eyes everywhere. So careful with LLP. That is younger sister of company, but not a company. So SQE tips and pitfalls. Let's talk about it. So LLP, compared to other structure, it combines limited liability like a company with management flexibility of partnership, no corporation tax, direct member involvement in management, and ongoing compliance like company. Tips, remember separate legal personality and limited liability. No formation requirement in default provisions. Distinguish members versus designated members. Authority rules, for example, actual, implied, and apparent. Then unfair prejudice petition is available in LLP. Tax transparency and winding up procedures, you need to understand them. And that's all, folks. If you have enjoyed this, give us a like, subscribe, and don't forget limited liability might protect your asset, but it won't protect you from a tricky SQE1 question. I wish you all the best. Ta-da!